All right, everybody, in this video, I wanted to take a break from the bull versus bear case videos and actually go into two companies who reported earnings over the last week. They are two very important companies to the North American economy, and that is the railways. I'm going to take CP Rail and CN Rail, kind of cross-examine them, look at each of the company's individual earnings, each of the company's kind of financial situation overall, and I'm kind of going to give my opinion as to which one I think is the better opportunity at this point in time. There is going to be a lot of valuable information inside this video that you might have not really looked at if you're a follower of the railways. I'm going to dive into all of that plus much more, so make sure you watch the video start to finish, and as always, like the video, subscribe to the channel, and comment down below if you want more videos like this. And as always, I have that report for my top 4 holdings inside of my portfolio. I do own one of these railways. Is it a top 4 position? You can find out by heading down to the description, grabbing that report absolutely free. It takes just a few seconds, but let's get right into the earnings. So first, let's look at them from an analyst perspective. If we look to CP first, we can see that quarterly earnings were expected to come in at around $1.13 per share, and they came in at $1.12. So a small miss there. When we look at revenue, it was estimated to come in at $3.81 billion, came in at $3.69. So again, another small miss there. And when we look to CN Rail, it was kind of much the same. Earnings came in pretty much right in line, $1.87 when pretty much $1.87 was expected. And we look to revenue, it was a small miss, $4.3 billion expected to $4.27. So both of these railways missed earnings estimates, and both of these railways are going through a very difficult environment in terms of freight, in terms of the overall economy, and in terms of just investor sentiment. However, when we look to these cyclical companies, the best times to add them is when the environment is like this. I know everybody loved the rails when they were running up, but now they somehow hate the railways now that they're trading at, in the case of CN Rail, it looks to be a 5-year low. These companies are rock solid. When the economy comes back, there is not very many shipping options by rail that do not include CP or CN Rail. But let's get right into the earnings, and let's first go over CN Rail. So the quarter was not a good one. We're looking at revenue ton miles, and this is effectively the amount of revenue the company gets per ton per mile. So if it ships a ton of freight a mile, the amount of money it generates on that would be the revenue ton mile. This is the most important KPI when it comes to a railway, and it's definitely one you're going to want to keep an eye on. So that decreased by 1%. Now, if we flip to CP Rail, we can see that volumes as measured in revenue ton miles increased 7%. So there is a big difference there. CP has managed to actually drive revenue increases, although volumes are struggling, whereas CN Rail really hasn't. If we go to overall revenues, we're looking at $4.27 billion for CP, so that's a decline of 1%. Again, if we flip back to CP Rail, revenues increased 3% to $3.7 billion. Now, if we look to operating ratios, which effectively is the railway's operating expense relative to its revenue, it came in at 61.7%. So what this is saying is for every dollar of revenue CN Rail generates, it costs them 61.7 cents to do so. So this operating ratio actually improved about 50 basis points on an adjusted basis. So the lower the operating ratio for railways, the better. And if we look to CP, we're actually looking at a better operating ratio. So we're looking at 60.7%, and that actually declined by 110 basis points, or about 1.1%. So thus far, we have revenues increasing for CP. We have operating ratios decreasing for CP, whereas CN Rail is kind of the reverse. We're seeing revenue decline, and we're seeing operating ratios not decline as much. So as a result, we have CP Rail. They reported adjusted earnings of around $1.12, which is actually a 7% increase. Now, if we come back to CN Rail, we're looking at earnings increasing by 2% on an adjusted basis. Now, this is largely at least for CN Rail, an element of share buybacks. So if we go to CN Rail's overall shares outstanding, you're going to see that they have been declining a lot over the last 10 years, and the company has made some actual aggressive attempts to buy back shares even over the last year or so, which has actually worked out to their detriment, unfortunately. But if we look to 1-year share counts, we're noticing that they are still reducing share counts by quite a bit. We're looking at around 0.5% over the last 3 months or so. So if we look to that from the start of the year, we're probably looking at 1% of shares being bought back. And ultimately, when you buy back shares, you increase your earnings per share. So this is likely along the lines of flat. It hasn't really increased all that much. So the buybacks are definitely fueling the growth of CN Rail right now, whereas for CP, higher efficiency and overall the Kansas City Southern acquisition is causing earnings to grow despite no share buybacks. Again, if we come here to Canadian Pacific and we look at their overall share counts, you can see that it has not really decreased much at all. They've started to buy back shares now that their debt is at a comfortable level, but this is not a company that has been aggressive on the buyback front thus far, but I'm going to get into that in a sec. The next thing I want to talk about is the outlook. So we come to CN Rail's report, and they said due to the economic uncertainty, they're going to be reducing their outlook. So CN now expects to deliver adjusted earnings growth in the mid to high single digit range in 2025. Before that, they expected 10 to 15%. So there's another addition to this. CN Rail actually removed its long-term outlook. So this is not something you see from the rails. This is not typical whatsoever. And it's definitely a concerning sign for the current economic environment and the current situation CN Rail is in. Now, if we go to CP Rail and we go down to their outlook, or at least their commentary on outlook, they said that they are confident in their ability to deliver full year guidance. And what CP Rail's full year guidance is double-digit earnings growth. So they are maintaining while CN Rail is kind of scaling back. So CP is a little more confident, but again, they do have those Kansas City Southern tailwinds, which are ultimately going to help them out, likely be able to boost earnings a little bit more, whereas CN Rail is kind of struggling. Now, the next thing I want to talk about, and one that is arguably the most important portion of the video, and is actually why, spoiler alert, I like CP Rail much more than CN Rail, is the overall capital allocation of these companies over the last while. So let's first look to what I believe should not be done in terms of CN Rail, and is actually one of the main reasons why I ended up selling this company and moving my money over to CP. If we look to this chart here, we can see the free cash flow of the company, which is effectively the company's operating income minus their capital expenditures. We can see that free cash flow generally always positive. It's been in a multi-year slide coming out of the pandemic, which is really not all that surprising because the environment for freight, things like that, it was sky high. These companies were doing very, very well, but you will notice a very critical mistake that CN Rail has made over the last 5 years or so. So if we look to the orange bar here, that would be dividends paid. And if we look to the purple bar, we can see that that is share repurchases. During 2022, CN Rail decided to go on an absolute crazy mission to buy back a ton of its shares and raise the dividend. I mean, we're talking about dividends paid jumping by $250 million from 2021 to 2022, and buybacks more than tripled. Well, what happened at the start of 2022? Ultimately, that was peak prices for these railways. I mean, we can come here and span this out to a 5-year chart. We can see that in 2022 here, that was pretty much the highest that the railways got, despite, at the start of 2024, before they went on this kind of big slide due to the slowdown in freight. So CP Rail spent more than they are bringing in. So free cash flow, effectively you have to pay your dividends out of free cash flow and you have to buy back your shares out of free cash flow. So we can see here in 2022, around $6.8 billion in dividends paid and shares purchased on only $3.9 billion in free cash flow. So the company is paying out way more than they're bringing in. They did this in 2023. They did this in 2024. And what happened to their share price over that time period? Well, it was effectively flat, increased a little bit, and now we're sliding down to the point where we are well below 2022 levels. We're talking, well, you can see here $172 a share. We're now at $130. So I would argue that this decision to purchase shares and raise the dividend during peak prices, I can understand the dividend, but the share buybacks really, really puzzled me. We were at a peak economic cycle, and ultimately what you want to do during a situation like this is shore up your balance sheet. You want to repay debt. You want to stop those share repurchases because ultimately you probably know that COVID environment is not going to last. But the company didn't end up doing this. And now we're in a situation right now, if we go back to their share price here, we're at discounted valuations relative to a historical basis. I would argue we're pretty much close to a bottom here at $129 a share. But now the company is in a position where they severely mismanaged. We're talking $11-12 billion. Imagine the ability for CN Rail to deploy that money now when their share price is down, from $177 a share down to $129. I do believe this is a severe mismanagement of capital. Whereas if we go to CP Rail, we can notice a stark difference. We come to 2020, they bought back, they were a routine buyer of shares, but we come to 2021, 2022, 2023, and 2024, they did not buy back a single share, and they also did not raise the dividend from 2022 to 2024. Now, why is this the case? Partially because they probably knew we were at an economic peak. They stopped buying back shares. This is a company that's fairly sporadic in their decision to raise the dividend and buy back shares. But the second thing that probably saved them from a bit of the buybacks was the Kansas City Southern acquisition. So the company purchased Kansas City Southern, and what it tried to do was prioritize debt repayment over all these other, buybacks, dividend growth, things like that. And the company did that. And now when we are sitting at, again, what I would call an economic bottom, or at least close to an economic bottom, you can see here the last 12 months, the company has started buying back shares. In fact, it bought back the most amount of shares that it has since 2015. It hasn't been this aggressive on the buyback front for a very long time, 10 years. In fact, they made a NCIB, like a buyback issuance, in February. They've already utilized 45% of the potential shares they can buy back. And they also ended up raising the dividend. Now, what is the key difference here? We look at a company like CP Rail, we look at their share price. They did not buy back any shares during this period of time when share prices were higher, share prices were flat. Instead, they're buying it back now that they're sitting at the lows. And you might be asking yourself, well, the share price isn't much lower than it was in 2022 and 2023. But the fact is, we have the Kansas City Southern acquisition factored in here. We have larger earnings relative to that share price today than we would have back in 2022. I mean, you can see this. If we come to earnings per share, we can see that earnings per share have grown quite a bit from those 2022 levels. We're looking at $2.89 a share. Now we're at $4.12. So there's a huge difference here. One, I believe, has made very, very strong decisions when it comes to their capital management, and one that has made very poor decisions. And moving forward, I cannot see how CP Rail is not in a better position than CN Rail to kind of continually be able to provide shareholder value through dividend raises, through share buybacks, especially at lower prices, and ultimately benefit from the Kansas City Southern acquisition, which does make it the first interconnected North American railway in existence. So typically, prior, if you were shipping parts from, say, Canada to Mexico, it would have to offload and go to a different train. The company can now ship it directly across to Mexico because it has that interconnected railway. Now, the final thing I want to discuss is valuations and ultimately which one I would buy today. I mean, I imagine which one I would probably buy today just because of my commentary throughout this video. But if we look to CP, we have the company trading at 40x trailing 12-month free cash flows, and we have the company trading at around 24.7x earnings. If we go to CN, we're looking at 25x free cash flow, and we're looking at 18x earnings. Now, this is a very, very big difference in valuation, especially if we look to a forward basis. We're looking at 15.5x earnings for CN Rail, and we're looking at 18.5 for CP. CP is much more expensive, but the situation here is CP is in a much better situation to navigate this environment. They have more tailwinds in terms of the fact they are continuing to grow revenue and become more efficient even in a relatively rough economy. And we have CN Rail, who is ultimately seeing revenue decline. They're seeing RTMs, revenue ton miles, decline. They wasted, I don't want to say wasted, but they spent a bunch of money ill-timed during the pandemic, whereas CP is now going to be able to utilize that money right now to buy back shares, raise the dividend, things like that. And for this reason, I'm still more bullish on Canadian Pacific than I am CN Rail. If I were to buy one today, it would be CP because I do like that interconnected railway. I love the fact that the company is growing earnings at a double-digit pace, whereas CN Rail is kind of struggling to grow earnings, period. And overall, the balance sheet for CP is better. The overall projected earnings growth is better. I mean, if we look to the PEG ratios, which would effectively measure the company's current price relative to its expected future growth, we're looking at 2.16 for CN Rail, and we're looking at 1.2 for CP. So for both these ratios, what they are effectively saying is the market is already pricing in the future growth of the railways. It's just pricing in much more of CN Rail at 2.16 than it is CP at 1.22. You would argue with a PEG of 1.22 that CP relative to its future growth is fairly valued, whereas CN Rail is overvalued. And when we actually look to those earnings estimates, let's go to an annual basis here. For this year, we're looking at, probably 40 cents in earnings per share growth. We're talking like low single digits. And then, once we come up here, we're looking at, 10% for 2026 and probably around 10% for 2027. When we look to CP on an annual basis, we're looking at double-digit growth in 2025, $4.74. And then we're going to continue to see that, 12 to 15% earnings per share growth over the next while. So this is probably why CP is trading at such a premium. In my opinion, it is the better operated company. Now, if you own CN Rail, I am not saying CN Rail is a poor company. I'm just saying over the last 5 years, pretty much every single thing when it comes to growth, when it comes to capital management, when it comes to share buybacks, dividend growth, and just overall operations, CP Rail has been the better performer. And I mean, it's reflected in its total share price. I mean, if we look to 5-year total return, we can see that CP is actually dominating CN Rail over the last half decade here. We're looking at total returns of around 47% for CP, whereas CN Rail is at about 9.5. When we go out to a 10-year period, it's even more. I mean, CP Rail is doubling almost the performance of CN, and you can see where this real separation started. It was back in 2022. There's been a clear differentiator here in terms of the overall effectiveness of these railways, and I do believe CP is the better operator at this point in time. So everybody, hope you liked the video. Head down below, like the video, subscribe to the channel. Let me know if you like videos like this, and I can definitely produce more of them. I'm open to hopping on the channel, discussing earnings, especially when I'm cross-referencing companies like this that are so easy to compare, but I need the feedback from you. If you like the bull versus bear case videos, let me know. I'll continue to put more of those out. And as always, everybody, grab that free report down in the description below, and we'll see you next time for more great Canadian content.